Hey guys, welcome back to the New Vision channel where we talk about all things real estate. Our goal with this channel is about learning and sharing sound principles of starting and growing a viable real estate business or any other business for that matter. In this video, we continue the series on real estate bookkeeping. And some of the things we are going to discuss here assumes that you are familiar with previous videos. So if you are new to the channel, you can follow the preceding videos in the playlists shown. In a previous video, we established the 6 rules that you need to follow in order to enter any financial business transactions into your accounting system. Rule number 1 was to determine the type of transaction involved. That is, does it bring money from outside into your business, move money within your business, or move money from your business to the outside world? Rule number 2 acknowledges that every transaction is a flow with at least one starting point and one ending point. So, any transaction entry that you do in your system must touch at least 2 accounts in your accounting system. Rule number 3 is to determine the starting point of the transaction, and rule number 4 is to determine the end point of the transaction. Once this is done, rule number 5 and 6 is to determine the effect of the transaction on the starting and ending points. In other words, whether it adds to or takes away from the starting and ending point. Now, according to rule number 5 and 6, the effect of the transaction on the starting and ending accounts, that is, whether it adds to it or takes away from these accounts, depends on what type of accounts are involved. That is, are these accounts assets, expenses, liabilities, equity or income accounts? Since this can be a little confusing, we summarized rules number 5 and 6 into a little cheat sheet that would help you to accurately enter any financial transaction into your bookkeeping system. In this video, we are going to take a few of the typical transactions that would occur in your real estate business and show you how you would apply these 6 steps to enter the transaction into your accounting system. To start, let's consider transaction number 1 that involves you making a capital contribution to your business. This is perhaps at the start of the business or to finance a new transaction. Now, according to rule number 1, this would be money flowing from outside into your business. Rule number 2 says we must touch at least 2 accounts to enter this transaction. So, to begin, let's find the starting point. Since this is money coming from you, we can easily see that the starting point must be an account in the equity category. We will name this account the owner contribution account. Being that you are contributing capital in cash, this cash will eventually flow to the business checking account, which is in the assets category, and will be the endpoint according to rule number 4. Now that we have determined our starting and end points, let's consider what this transaction does to those accounts. For this, we don't need to overthink it. We simply need to look at our cheat sheet. And according to the cheat sheet, our starting point is an equity account. And so the transaction must increase it according to rule number 5. So we move over here and add the transaction amount to the owner contribution account. Next, and once again, according to the cheat sheet, we see that the endpoint is an asset account and must also be increased by this transaction. So we move over to the business checking account and add the corresponding amount. And that's it. This transaction is fully entered into our bookkeeping system. Going forward, and in order to keep this video from becoming too long, we are not going to call out the rules at each level. Hopefully, the example above illustrates how we apply them, and we are just going to focus on the other use cases. The next example we are going to consider is a tenant paying rent. Once again, this is money flowing from outside into the business. And we know we are going to need at least 2 accounts to enter it. we can see that this is money flowing from the tenant through the income checkpoint into the business checking account. So, our starting point is the rent account in the income category, and our end point is the business checking account under the asset category. To see the effect of this transaction on these accounts, we consult the cheat sheet, from which we see that the transaction must be entered as an increase to the starting account, which is an income account. So we will come to the rent account and register the increase of $1,000. We also see that the transaction causes an increase to the endpoint, which is an asset account. So we come over here and register the $1,000 increase in the business checking account. And that concludes the entry for this transaction. The third transaction we consider is the tenant paying security deposit. Again, this money is flowing from the outside through the liability checkpoint into the business checking account. So, our starting point is the security deposit account in the liability category, and our end point is the business checking account in the assets category. Consulting our cheat sheet yet again, we see that this transaction should be entered as an increase in the starting point. So we register the $1,000 entry in the security deposit account. We also see that this transaction should be entered as an increase to the endpoint. So we move over and register the $1,000 in the business checking account, thereby concluding the entry of this transaction. Transaction number 4 that we consider is the case where you are paying a contractor for work done. This is the first transaction that is causing money to leave the business and flow to the outside world. In this case, the money is coming from the business checking account and flowing through the expense checkpoint to the contractor. So, our starting point is the business checking account, and the end point is the repair account in the expense category. Looking at our cheat sheet, we see that this transaction will cause a decrease to the starting point. So we move over here and register a decrease to the business checking account for the expense amount. And we also see that the transaction causes an increase in the end point. So we move over here and register that increase in the repair account for the amount of the expense. And we are done. For transaction number 5, we consider the case where you buy repair supplies using a business credit card. This one is an interesting transaction because we see that the money is coming from outside and flowing into the business as a liability in the form of the credit card, and at the same time, that money flows right out of the business as an expense through the expense category. So our starting point will be the credit card account in the liability category, and our end point will be the supplies account in the expense category. Once again, consulting our cheat sheet, we see that this transaction causes an increase in the starting point. So we come over to the credit card account and we enter the amount of the transaction as an increase. We also see that the transaction causes an increase to the endpoint, so we come over to the supplies account and enter the amount of the transaction as an increase. And that completes the entry of this transaction. The transaction example we consider next is paying the mortgage. Now, when you pay the mortgage, clearly that money is coming out of the business and flowing to the lenders. So, your starting point in this case is the business checking account. What is interesting in this case is that there are 2 endpoints. And that is because the mortgage payment for most loans has 2 parts to it. One part is going to pay the interest to the lender, which is an expense, and the other part is going to pay the principal to the loan, which is a liability. Looking at the cheat sheet, we see that this transaction causes a decrease to the starting point. So we come over to the business checking account and deduct the mortgage payment. We also see from the cheat sheet that the expense checkpoint for this transaction causes also an increase. So we come over to the mortgage interest account and enter the increased expense. Finally, we see from the liability endpoint that this transaction causes a reduction in the mortgage liability. So we come over to the mortgage principal account and enter the amount of the reduction in the principal. For the next transaction example, we consider paying off a credit card balance. Now remember that credit card expense that you made in example 5 above. Now that your business has made some money and it is time to pay off the credit card balance. We are assuming that you are making this payment before the credit card company charges any interest. Once again, this is money flowing from your business to the credit card lender. So, your starting point will be the business checking account and your end point will be the credit card account in the liability category. Looking at our cheat sheet, we see that this transaction causes a decrease in the starting point. So we come over to the business checking account and register this decrease. We also see that the transaction causes a decrease in the endpoint, so we come over to the credit card account and enter this reduction in the credit card liability. Finally, we consider a transaction that involves you taking some money out of your business as an owner for personal use. This is, after all, one of the big reasons for having a business, that it should be able to support you at some point. Once again, this would be money flowing out of your business to you as an owner, and it will do so through the equity checkpoint. So, our starting point will be the business checking account, and the end point is the owner withdrawal account in the equity category. We will see from our cheat sheet that this transaction will cause a reduction in the starting point. So we come over to the business checking account and enter this reduction. We also see that the transaction causes a reduction to the endpoint, so we come over here and enter the reduction in the owner withdrawal account. Hopefully, the handful of examples that we have considered here gives you an idea of how to think about these transaction flows and subsequently how to enter them into your bookkeeping system. Please let us know in the comments below if you have any questions and if you find this type of content helpful. You would be encouraging us to create more by clicking the like button and subscribing to our channel. And while you're at it, please click that notification button so that you will immediately know when we put out new content. Many thanks and see you in the next video.